All right, now it's recording. Okay, coming back to the PowerPoint slide. So where is it? Right. On the receivable, all right, look at the overall picture of the asset. So asset, we have the current asset and the non-current asset. And the current asset, you have cash and cash equivalents, which we covered in the previous class. And then we also have inventory. We also have covered that. We have receivable. So here is what we are looking at, right? So under receivable, we're looking at the objective and the definition and classification, initial recognition and measurement, and the presentation. So all these 4 items are that you should be able to do or to understand under the topic of receivable. Right. So what is the objective of providing information on receivable? Right. So the objective is so that the user of financial statements are interested to know the useful information on receivable and how the information can help them in making decision about the entity. All right. Remember that at the end of the day, it's always about so what. Yeah. So you provide information about receivable. So how can I make use of the information about the receivable, right, in the financial statement? Right. For example, here we have an entity that sells goods on credit. All right. So sell goods on credit to most of its customers with an interesting credit policies. So the solution here is that the existing and potential investor may be interested in the cash collection from the customers, right? Because when you make sales on credit, it means that you make sales and then you're going to collect the money later. All right. So of course, we want to know that if you make sales, it's good, but sales on credit, how do you actually make collection of the credit from your customers, right? Because why? If the entity fails to collect cash from the customers, the existing and potential investor may indicate that entity is having a liquidity problem. Yes, you can make sales, that's good, but you don't have cash because why? All the sales are on credit. And if you fail to collect the money from the customers, then you will have a cash issue. Or in this case, you have liquidity problem. All right, but if their credit policies can attract customers to make prompt payment, then the existing and potential investor may invest some more cash into the entity. So that's why we need to provide information about the receivable, or how much is your receivable, and then later you will have to see whether the classification of your receivable and what are the method of collection. Hold on. Where is this? I see nothing. Okay. Okay. Because I heard that someone is coming in. Is there anyone coming in? Right. Oh, Mark Ashraf. Okay. All right. So that is on the why we provide information on your receivable. And then slideshow. All right, so with regard to your learning objective, 1 is to define and explain common types of receivable and generalize sales on credit. So you should be able to do this right after we explain everything. All right, so what are common types of receivable and how our credit sales are recorded? So a receivable occurs when a business sells goods or services to another party on account, or sometimes we call it as on credit, meaning that you make sales, but the customer has not paid you, they will pay you in the future. All right, so a receivable is a monetary claim against a business or an individual. So a receivable is a right to receive, that's why namanya receivable, yeah, to receive cash in the future from a current transaction. So a creditor is the party who are going to receive, right, who receive a receivable, and debtor is the party to a credit transaction who is obligated to pay later. So when you're talking about buying and selling, if you sell on credit, so the seller is the creditor. all right, and the buyer or the customer is the, in this case, is the, you give credit to your customer. So your customer is your debtor. So the debtor are going to pay your creditor later, right? So that's why a creditor is the one who is going to have a receivable. So now you have created an account, what we call accounts receivable. Sometimes you also call trade receivable. Right, so when you have receivable or trade receivable, it represents the right to receive cash in the future from customers. Why customers? Because this one is clearly it's because of the buying and selling of your merchandise. So that's why it's called trade receivable, right? So it's from your customers for goods or services that you have performed. So generally, all right, this receivable is going to be collected within 30 to 60 days. Right, and then you are going to report your receivable as a current asset on your balance sheet. Right, another types of receivable is what we call notes receivable. All right, previously it's an accounts receivable, now it's a notes receivable. The difference is that notes receivable have a longer terms than account receivable. Right, sometimes it's called promissory notes, and it represents a promise to pay a fixed amount of principal plus interest by a certain due date, right? And the maturity date is the date on which a note receivable is due. So notes receivable is more of a more specific contract, right? And we also have other receivables, right? Other receivable are any type of receivable. It could be classified as either current or long term, depending on whether they will be received within 1 year or longer. So if you're going to receive, all right, within 1 year, so it's going to be a current asset. But if it's more than 1 year, it will be under long term. Right? Example of other receivable includes dividends receivable. So it means that you are going to receive the dividend in the future. Interest receivable, so you're going to receive interest, and also we also have taxes receivable, right? And then the definition and classification of trade receivable. So this one is expanded in MFRS 132, right? As an entity claim to the future collection of cash or service with fixed or determinable payments, right? So it's going to be a current asset when it's expected to realize, and then it's intended to sell or consume in its normal operating cycle. And then it holds the asset primarily for the purpose of trading and is expected to realize within 12 months, right? So that is your trade receivable. Right, example, an entity provides cleaning service to one of its customers for 6 months, right? And the customer promised to settle the payment once the job is completed. So there will be a claim of cash made to the customer after the completion of the service in its normal accounting cycle. So the claim here, which is the trade receivable, is classified as current asset in the financial statement because it's held for the purpose of trading, and it will be realized within 12 months after the reporting period. Right. Initial recognition of trade receivable, it will be recognized as a financial asset or financial liability in its statement, depending, yeah. But of course, receivable is a financial asset. When you become a party to the contractual provision, right? So an entity provides cleaning service to one of its customers for 3 months. Customer promised to settle 50,000 once the job is completed. So in this case, a trade receivable is to be recognized in the financial statement because the entity has become a party to the contractual provision and also has contractual right to receive cash 50,000 after the completion of the service. So why is it very lengthy, all these wordings, all that is because it's based on the MFRS, in this case, MRS 132, for the how to recognize, yeah, your trade receivable. And the trade receivable is measured at fair value of the consideration received or receivable, right? So how you record your sales transaction on credit. So Smart Touch Learning provide 5,000 in service to ground on account. So when you say on account, it means that it's on credit and sells 10,000 sales price or merchandise to Smith on account on August 8th. So ignore cost of goods sold. So in this case, when you have mixed sales, all right, so in this case, you're going to debit your accounts receivable. In this case, your account receivable, you have to create separate accounts for separate customers. Yeah. So in this case, for Brown, you make sales of 5,000 on credit, and on the 8th August, you make sales of 10,000 to Smith. So you're going to open two separate accounts, receivable, and both accounts you're going to credit your sales revenue. Yeah. And then you are going to debit your accounts receivable, all right? And then this is what we call, there are two. The control account, which is the account receivable, shows a balance of 15,000. Right, so now you say that, okay, I have a different customer, so I'm going to open up each customer one account receivable. So for this each of your customer, you're going to have what we call a subsidiary account. Right, so under subsidiary accounts, you're going to have individual accounts receivable. So accounts receivable, in this case, Brown, you have a balance of 5,000, and Smith, you have 10,000. So in total, you are going to have 15,000 accounts receivable. So the control account shows you only one, right? The totality of your accounts receivable is 15,000. But if you want to know the details of your account receivable, then you have to go to the subsidiary account, which is the individual accounts of your receivable. Yeah, so you have the control accounts, which is the totality, but subsidiary accounts is the individual accounts of your accounts receivable. Recording sales on credit, right? When the business collect cash from customer, right, 4,000 from Brown and 8,000 from Smith, then you're going to make the following entries, right? So when you receive cash, you're going to debit cash, and then because now account receivable reduces because they make payment, so you're going to credit your account receivable from Brown and credit account receivable from Smith, right? So why? Because now you are reducing their balances. So if you look into their accounts, you see that your subsidiary accounts, Brown, initially you recorded that as 5,000, but now they make payment of 4,000. So you debit your cash, credit your Brown. So because of that, the balance is 1,000. Similarly, for Smith, all right, you have initially 10,000, but then you credit your Smith 8,000, so balance is 2,000. So if you look at the balance here, all right, no balance, all right, you have balance, initially it was 15,000, but now you credit 12,000. So now you have a balance of 3,000, yeah? All right, presentation of trade receivable as a current asset. So you see where is your trade receivable? Yeah, you have it here, current asset, you have trade and other receivable, right? And then you have to refer to the notes later. So it's under current asset. This is your statement of your financial position where you have all your non-current asset and then you have your current asset. Under current asset, you have inventories, trade and receivable, and then you have your cash. So what we are looking at now is the trade and other receivable. Right, so sometimes company also give discount. Yeah, so for example, if you purchase a certain amount of volume, then in order to promote sales as well as to encourage, they give discounts. Yeah, so the company offers sales discount to encourage bulk purchase and also to prompt payment in order to encourage them to make a payment. Yeah, they give discounts. So for example, here we have during the year, Focus I Berhad sold goods to G Berhad for 1,000. A trade discount of 10% is given to G, determine the amount to be measured in the trade receivable account. Right, so initially it was 1,000, but now you are given 10% discount. So the initial measurement of the receivable can be done as follows. So you debit your 900. Why 900? Because you record at net. Why 900? Initially it was 1,000, but you are given 10% discount. So you only have to pay 900 later. So when you have 900, you debit your 900, credit your sales of 900 as well. So you don't show the 1000 because why? You record at net. So net sales is 900. All right, and then you also have a cash discount. Right, cash discount is given on the amount owed by the customer. For example, Focus I sold goods at a quoted price 10,000 with a credit term 210 net 90. So what do you mean by 210 net 90? Right? Determine the amount to be measured in the trade receivable. So first you have to understand what do you mean by, let me see here, I want to use, I cannot do anything, is it? Why can I? Why is this CC? Oh, I don't know. All right, so I want to look at this. What do you mean by 210 net 90? Right? So the initial measurement of receivable is that initially it was quoted at 10,000. So you debit your receivable 10,000, credit sales of 10,000. But if 210.90, it means that if you pay within 10 days, all right, I will give you 2% discount. Right? I will give you 2% discount, otherwise it's net at 90. What is that? Means that you only have to pay 90% of the 10,000. So if, all right, the customer pays you within 10 days, then you should give them 2% discount. So how you compute 2% discount is that 10,000, right, times by 0.02, which is 200. So the 200 is the discount, so you're going to debit bank, right, instead of receiving 10,000, but you only receive 9,800 because why? You give discount of 200. So you're going to debit your discount allowed. So remember that when you give discount here it means that you're supposed to receive 10,000, but because you give discount, you only receive 9,800. So the 200 ringgit discount given is seen as an expense to the company. So remember that expense is always a debit entry. So that's why you debit your discount allowed 200. Right? But you credit your receivable 10,000. Why? Because in the first place, you have recorded your receivable as 10,000. But why you only pay 9,008? Because you pay within the 10 days period. So you get a 2% discount. Is that clear?
Madam?
Yes.
What does it mean by net 90?
So net 90, it means that if you pay within 10 days, oh net 90 kat situ ya. Oh bukan, it's not 90% ya. What is that net 90? Anyone? So ni credit term 210, net 90. Oh, okay. All right. It means that if you pay within 10 days, I give you 2% off. But if you don't pay within, you are given 90 days to pay for that amount. Yeah, net 90 means that is the remaining, the number of number of days, right, given as a credit. Yeah, but if you pay earlier, I give you 2% discount. How much earlier? 10 days earlier. All right, is that okay? All right, sales return. All right, another one we talk about when you make sales, sometimes there's a sales return. Right, it means that the customer can return the product that do not meet their requirements. So how are you going to record a sales return? So in January, Focus I sold goods on credit to its customer amounting to 19,000. The customer returns some faulty products of 2,000, determine the amount to be measured in the trade receivable account and sales return account. So when you have a sales return, so what you have to do is that initially you have to record sales of 19,000. So you debit your trade receivable and credit your sales of 19,000. But later, when there's a return, you are going to debit sales return. All right, when you have sales return, is a contra account, right? Contra account means that sales return is a contra account to which account? Sales return?
Receivable?
No. Sales return is a contra to a sales account. So kalau sales is a credit, right, because it's a revenue, sales return is a debit. Why sales return account is debit? Because it's a contra to the sales account. Does that make sense? Can you remember that?
Yes.
Right? So
Yes.
you debit your sales return because it's a contra to your sales account. It's not an expense. Yeah? You don't call it as an expense. You do not debit sales return because it's an expense. You debit your sales return because it's a contra account to your sales. Yeah. So you debit your sales return 2,000 and credit your trade receivable 2,000. Right. So if you look at your trade receivable, initially you have debited 19,000. Now you credit 2,000. So the balance is 17,000 in your trade receivable. All right. And then you also have the other one, what we call sales discount. All right. Sales discount. Macam tadi tu sama je. During the year focus, I sold. I need to do mana ni? Sales discount, sales return. All right. Okay, so are you clear about your learning objective 1, where you have to recognize your sales and your receivable, how to record your sales return, sales on credit, and how to record your sales discount? Is that clear?
Yes, madam.
Right, LO2, we are going to apply direct write-off method for uncollectibles. What it says is that, all right, remember that when you make sales on credit, right, so your customer will have to pay you in the future, later. That's why we call it as a receivable. But careful that, because not all of your sales credit, all right, not all of your customer will pay you 100%. All right, it could be that some of the customers don't pay you, right? So when they don't pay you, then you have to write off those uncollectibles. So these uncollectibles is an expense to the company. So we call it as a hutang, yeah, it's an uncollectibles. So bad debts, and then you have two accounts what we call bad debts and allowance for doubtful debts. There are two separate accounts. So bad debt expense arises from failure to collect from some customer who purchase on account. So when you have a bad debt, it means that the debt is bad already. It means that you cannot collect anymore. All right. The allowance for doubtful debt is reviewed periodically, and it's just a provision. All right. So if bad debts is the actual uncollectible amount, allowance is just a provision. Has it incurred? Not yet. All right. Provision means that you just provide certain amount that you think that may be uncollectible. So that's why it's called as a doubtful debt. Debt which is doubtful debt. You think that how much of your total receivable which is may not be collectible. Yeah. So for you to do that, all right, there are two methods. One is the direct write-off method, which is not allowed by the standard. And the other one is what we call allowance method, which is allowed by the standard. So of course, we want to go for the second one, which is the allowance method. Yeah. But they also show you the direct write-off method. I do not know why it's not allowed by the standard. Why still have to show this? Maybe, all right, you should know what is not recognized by the standard. Yeah. So the direct write-off method is a method of accounting for uncollectible receivable in which the company record bad debts as spent when a customer account is uncollectible. So that is the definition, right? So this method is primarily used by small and non-public companies. So because it's easier, yeah. So you, whenever there's uncollectible, you just write off immediately. So what happens is that account receivable are written off when the business determines that it will never collect from the specific customer. Once an account receivable is written off, the company stops pursuing the collection, right? So this is what we call the first method, what we call the direct write-off method. Okay, now you want to apply, what is the objective number 2? Just now, apply the write-off method, right? So now number 3, we want to go for what if you use allowance method, right, for uncollectible and estimate bad debt expense. So what happened is that we want to use the allowance method. How are uncollectibles accounted for when using the allowance method? All right, so most companies use the allowance method to measure bad debts. All right, it's based on the matching principle and it records bad debts in the same period as the sales revenue. So a contra asset, so this is another contra asset called allowance for bad debts, reduce the accounts receivable to the net realizable value. Right, so you have under this method, you're going to create one account which is called allowance for bad debts. And then because this allowance for bad debts will reduce your accounts receivable to the net realizable value. So the term net realizable value means that how much is the realizable, how much is collectible from the customer after taking into account some allowance. Right? All right, as of December, Smart Touch Learning estimate 80 of its 4,400 accounts receivable are uncollectible. So when you have recognized that 80 is uncollectible, so you're going to debit your bad debt expense and credit your allowance for bad debts. All right, remember that bad debts is an expense, so that's why it's debited. Credit your allowance for bad debt, and this one is a contra account to your accounts receivable. Right? So that's how that would be your double entry. So initially you have account receivable 4,400 debit, you credit your allowance for bad debt 80, and you debit your bad debt expenses. So you do not touch account receivable yet because now you only provide allowance. All right. Has it become bad? Not yet actually, yeah, but you only estimate. Right, so when you have that, you're going to have your account receivable and then minus your allowance for bad debt. So that's why I say that allowance for bad debt is the contra account for your accounts receivable. So your credit here, then 4320 is what we call the net realizable value. Right?
Madam,
Yes.
can I ask,
Mm-hmm.
bad debt expenses is same like hutang ragu and
Yes, it
peruntukan
is.
baru?
Yes, it is.
I see. Thank you, ma'am.
Yeah, but it is here we are I'm showing you how to record the bad debts under the uncollectible under allowance method. So you have to follow this method lah. Whenever you have an estimate, so you are going to debit your bad debt expense, credit your allowance for bad debts. Yeah. So and then you have to show your allowance for bad debt as a contra against your accounts receivable. So writing off. So when it actually an allowance is established for the estimated, all right, instead of recording debit to bad debt expense, the company record a debit to allowance for bad debts, right? But just now I saw a bad debt expense. Why do you have to debit bad debt expense? The entry to write off an account under the allowance method has no effect on net income at the time of entry. Yeah, because it's just not. But bad debt is debited, right? It cannot collect total 25 from its customer Sean, so you're going to allow for bad debt debit and credit 25 accounts receivable. Hold on, yeah. Smart Touch Learning determined that it cannot collect a total of 25 from its customer Sean Clark. Is this Sean Clark the one that you provide? Images account receivable. So this one is determined it cannot collect, so you debit your allowance for bad debts and credit your Clark account receivable. All right, let me check first. All right, you debit. Just now you credit your allowance for bad debts, right? So this one is when you estimate. But when it actually happened, you're going to debit your allowance for bad debt and credit your accounts receivable. Right, because when you have your initial, when you estimate, all right, you do not reduce your account receivable yet. Right, you only provide a provision. So you only deal with your bad debts expense and your allowance for bad debts. But when you actually cannot collect, then only you debit your allowance for bad debts and credit your account receivable. So if you look at this, right, initially account receivable, initially it was 4,400 and then minus 80, you have NRV of 4320. But after write-off, where do you get 4375? You have to increase, right? You have to do adjustment in your allowance for your bad debts. But where do you get that 4375? Okay, account receivable, because you debited, nampak tak, 25,000 here, you debit your account receivable. So your account receivable here, you have a balance of 4375. So that's why you start with 4375 and then you minus your bad debts, allowance for bad debt. So let's look at allowance for bad debt. Initially you have 80 and then you debit 25, so the balance is 55. Okay, so that's why you 4375 is because account receivable has deducted the uncollectible amount, and the allowance for bad debt is adjusted in order to take into account the actual amount which is uncollectible. Are you okay here? So before your write-off, you see that it does not affect your account receivable because you only estimate 80. But when it's actually happened, you actually write off, all right, then you see that the account receivable now reduced by the amount which is uncollectible, right? And the allowance for bad debt now changes from 80, now become 55. Why? Because it has reduced by the amount which is uncollectible, right? So you debit your account receivable, credit allowance for bad debt, debit your cash. Why you debit your cash? All right, here, all right, in this example is that in it, remember last time you have credited your, you have write off 25 from Sean Clark, and now March 4th, right, the Smart Touch Learning and unexpectedly received $25 cash from Clark. So remember just now you have actually write off the 25, but now you receive 25 from the debtor. So when you receive that, right, March 4th, you have debited, you have to debit again 25, right? You have to put back the 25 into the accounts receivable, and you're going to credit your allowance for bad debt. Confused, kan? It's a bit confusing here because remember just now, right, when you write off, you have write off on January 10, 25. So you have reduced your account receivable. It means that you know that, okay, I'm not going to receive from account receivable. Right? That's why my balance is 4375. But now suddenly when there's a recovery, right, suddenly your customer comes and pay you, then you have to create again. Right? Put in the amount that they are paying. You have to put into the account receivable. So that's why you debit your account receivable and credit your allowance for bad debt, because why is a contra account, right? And then why you debit cash, because when you make payment, right, receive receivable is a receive cash from your customer, so you debit your cash and credit your account receivable. So you set off lah, right? In order for you to create this, you have to debit your account receivable, then you credit again, yeah, because they make payment, right? And then this is only note number 9. I do not know. Are you okay here? This one is very important. Is it okay?
Yes, madam.
Yes, madam.
Right. Now estimating and recording bad debt expense under allowance method. All right, company estimate bad debt. So how are you going to do the estimation of bad debt? So normally you use past experience, all right, and then sometimes common industry have a certain method of providing allowance and other variables, all right? So there are 3 methods for you to estimate uncollectibles, yeah? Percent of sales, percentage of receivable, and aging of your receivable. So percentage of sales, it means that you just compute your bad debt expense as a percentage of your net credit sales. Some company use sales, not just credit sales. So all sales. So remember, sale, there are 2 types of sales. One is the cash sales, the other one is the credit sales. So it depends on the company's policy whether they want to base on the credit sales only or they want to base on total sales, which is the cash plus credit sales. This method is also called the income statement approach. Right, percentage of sales, for example here, the past experience suggested that 0.05% of credit sales will be uncollectible, which amounted to 60,000 for the year. So how do you compute? You have your sales 60,000 for the year times by 0.05. Sorry, 0.5% is translated into 0.005. Right, so 0.05, how you know? 0.5 divided by 100. Right, you get 0.005. So careful with that, yeah. So when you want to compute, all right, you have 60,000 times 0.5%. So 0.5 divided by 100. Right, so that's what you mean by 0.5%. So that's how you compute 0.005. So from there, you get a bad debt expense of 300. And again, this is an estimate. So when you have that 300, you're going to debit your bad debt expense, credit your allowance for bad debt. Right? Allowance for bad debt. So this is the method when you, the only time bad debt expense is recorded is as an adjusting entries. Right? So you do that. But percentage of sales method, percentage of sales is similar just now, okay? After posting the adjusting entry, volume balance, then not to do. Okay, assume that collection on account during the year are 58,000. So where is 58,000? We have 60, initially it was 4,400, net credit says 60,000. Right, so based on these, collection 58,000, what is this? Oh, it means that assume that collections on account during the year. So it means the account receivable that make payment to you is 58,000. So now you have the balance of 6375. Yeah. So what happens is that beginning of the period, you have 4,400 balance of account receivable plus your credit sales 60,000. And then you have a write-off of 25 just now. And then you collected 58,000 from your account receivable. So you debit your cash, credit your account receivable. Right, so I've done, then you compute what is the balancing figure. This one, you have 6375. So your allowance for bad debt, initially you have 80, then you write off 25, so credit 55. And remember that you have the additional allowance of 300, so you put in 300. Now the new balance is 355. Your bad debt expense, initially it was 0, right? Then you create an adjusted of 300. Now bad debt expense is 300. All right, what about your percentage of receivable, right? What is your receivable? Means that just now it's based on sales. So sales could be sales based on credit only, or you can have total sales. But if you talk about receivable, then whatever balance of your receivable, you're going to take the certain percentage, right? So number one, determine what is the target balance of allowance for bad debt. So target balance, for example, ending balance of account receivable times certain percentage. So that will be your allowance for bad debts for the year. And then determine the amount of bad debt expense by evaluating the allowance account. So your bad debt expense is target balance of your account for allowance for bad debt minus unadjusted credit balance. Wow, this is very challenging. Right? Let's look at the example here. Smart Touch Learning unadjusted account receivable is 6375. 4% account receivable is estimated to be uncollectible. So 4% of your 6375, is it? So 6375 times by 0.004. Yeah, 4.4%, which is 225.5. Berapa dapat 25.5? 6375 times by 0.04. 255, yeah. Calculate the target balance. So you have a 255 The bad debt expense adjustment must be calculated based on the target balance, which is 255 minus 55. So you have a credit balance of 55, so the adjustment is 200. So you use that as a balancing figure, right? So if you have that and just of 80 minus 25 is 55, but then you estimate 4% of your account receivable is 255, so it means that you have to do adjustment of 200. Percentage of receivable method, record the following adjustments. So you're going to debit bad debt expense, credit your allowance for 200. Yeah, so how you get the 200 is the balancing figure here. This is, yes, I know that this one is a bit confusing. Yeah, but that's the method used by the MFRS. Receivable, remember that has a credit unadjusted balance because the company overestimate the bad debt, so that's why you credit. Okay, let's look at another example. Martin Music has a debit balance in allowance for bad debts. Uncollectible will be 2% of 40,000. So 40,000 times by 0.02, which is 800. So 800 is the closing figure. So you already have a 150 beginning. So 800 minus 150, you should get 650 as the silang. Berapa 950 ya? You have 150 there. In order to have a closing figure of 800, you must have 800. So in order to get 800, you will have 950. $950 minus 150, you get 800. So the balancing figure is 950 instead of the 650. Okay, do you know how to get the 950?
Is that because of allowance for bad debt?
Yeah, because allowance initially you already have 150 and you want to have a closing of 800. Yeah. So if you had a closing of 800, that's why you have to have a debit of a credit of 950 on the credit side. So 950 minus 150, then you get 800 as a closing figure. Do you get that? So you must know how much is actually to be adjusted, right? Because you have to first decide what is the closing figure for your allowance. So you know that the allowance closing must be 800. Why 800? Because that is 2% of your 40,000. So if the closing is 800, then you must know that you already have 150 on the credit side, means that on the debit side, the adjustment must be 950. Okay, so later when we do tutorial, we can see this clearer. Right, aging of receivable. So this is the third method, the aging of your receivable. Is almost similar to percentage of receivable. Business are grouped into individual account based on how long the receivable has been outstanding. So different percentage are applied to each category. So means that when you talk about aging, means that all your receivable will be put into groups, right? Depending on how many days of the aging, right? So for example, here you have aging means that, okay, how many of your customer that will pay within 30 days, right? So these are your customer. Broadson that owes you 800 will pay within 30 days. Pai Chi Fraternity, and then you have parents. So you, in this case, you know that, all right, these are the amount 4245 that you should be received within 30 days, right? So, and then that's how you got 4245. And those customers that will pay within 31 to 60 days. So this is what we call you aging. You put your customer into the respective aging period, right? So you have Andrews and Jones will pay within 31 to 60 days. And you have within 90 days, you have Thompson to pay you. And over 90 days, you have Clark. Right, so these are the total balance of each of the customer, and this is the totality 6375. So when I say that we're going to estimate based on aging, right, we're going to give you certain percentage, and the percentage applied to each category is different. Why? Because for example, you see that here, all right, for those who are paying you within 30 days is 1% only, right? The means that you estimate that the amount that will be uncollectible for those 30 days is very small. But the longer the period means that the more likely it will be uncollectible. So for example, for those over 90 days or 3 months, right, unlikely is most likely that you can only collect 90% of that, or 90% of that will become uncollectible, right? Again, I put it like this. Based on the 90 days, all right, it's estimated that 90% of the amount due, which is 100, will become uncollectible. So if 90% means that the amount is 90, right? If 1% means that the likelihood for you to become uncollectible is very small, because the number of days is still very new. Yeah. So estimated total uncollectible, so you have a total of 185. So that 185 you're going to debit in your debt expense, and you have this account AFDD is your allowance for your bad debts just now. AFDD, yeah, they call it as AFDD. What is AFDD? Allowance for doubtful debts, right? But previously what we call it is allowance for bad debt, so it's the same account actually, yeah. If you want to put in short, you can just put AFDD. So debit your bad debt, credit your AFDD, right? And so for example, in this case, we're going to debit how much? Debit your bad debt 185, credit your AFDD, is it 85? 185. Right? What is this? Recording allowance for doubtful debts, estimated uncollectible, recording the write-off and uncollectible. So here, alright, kenapa lah? Okay, I want to take this. Where is this? Ni kat mana? Right, this one is to record the write-off. Where do I put here? Boleh lah. Mana lah letaknya? Macam tak cukup je ni. Ada account receivable lagi ni. Ni tak tahulah I. I nak merge lah benda ni. Boleh juga. Where do I put? Alright, the write-off, and this one should be, where is it?
It's 3 o'clock.
What is this? What is happening? I'll move this away. Okay. satu kali. Ni recording ni command X should be X. Okay. Ni tarik sikit. Mana tajuk dia tadi? Okay. Alright, so different is that ni boleh dulu. Right, the difference is that this one is to record the allowance. Alright, so you debit your bad debt, credit AFDD. So this one is just an estimate. Alright, but if it's a decrease in the allowance, alright, then you debit your AFDD, credit your bad debt expense. Barulah cukup. Okay. Looks better, right? Okay. Right, so it should be. So, and then if there is a bad debt recovery, then you are going to debit account receivable, credit AFDD, and then debit cash and then credit account receivable again. Right? Why you have to debit and credit account receivable? Because you have to create that amount which is recovered, all right, and then you credit your AFDD, then only you set off debit cash again and credit account receivable. Means that you have to create that account first, that amount. Okay, and then we have the note receivable. Right, remember that the note receivable, right, normally is a notes, right, that have the principal and the interest. So a note receivable is a promissory note. It's a written promise to pay a specified amount of money at a particular future date, usually with an interest. Right, maker of the note, which is the debtor, that signed the note and promised to pay the required amount. The maker of the note is the debtor. Payee is the note of the note is the creditor, the entity whom the maker promised future payment. The payee of the note is the creditor. Right, so for example, if you borrow money from someone, then you write a note to him that say that, okay, I will pay you in the future. Right. So you have, because normally they come with the interest, so you have the principal amount, which is the amount loan, and then you have the interest on the loan and interest period for how long. So you will have all this information in the notes. Yeah, notes receivable. So example here, we have the principal amount is 1,000, is the date, and then this is the person who promised to pay Smart Touch Learning 1,000, right? And then on September 30th, so 2020. So the period here is 2019 and you promised to pay in 2020. So this is the principal amount, and then principal 1,100, is it? So the interest period ends on the maturity date. So the interest portion, what is the interest? The interest rate is 6%, right? So it's mentioned clearly in the note that the principal is 1,000. So upon maturity, how much is the amount due? 1,000 times by 1.06, right? Because you have to pay 100% plus 6%. 100% is the principal, 6% is the interest. So total you have to pay is 1.06. So it means that you have to pay $1,060. Yeah. So that's how you compute what is the amount due upon maturity. So whatever amount times by 1.06, in this case is the interest rate. If you time 1,000 times by 1, so it means that you are going to pay 1,000 only. So there's no interest. But if there is an interest, means that you are going to pay 1.06, right? Depending. In this case, interest is 6%. So you time 1,000 times by 1.06. And in this case, Lauren, 1,000 for 1 year, annual rate is 6%. So when you receive, you're going to debit your notes receivable, and then you have to make payment of 1,000. Yeah. Right. The maturity date could be in the form of date. It could be in number of days. All right. It could be also if it's not mentioned number of days, not mentioned the date, then you have to compute the number of days. 180-day note dated February 16 matures August 15, shown here. So you sign on February 16, right? So 28 in the month of February minus 16, you already have 12 days there. Right, then March have 31 days, 30 days, 31 days, 30 days in June, July 31 days, and August, which is the maturity, 15, all right, 15 days. So you are given 180 days. So that's how you decide when is the maturity date. You have to complete total of 180 days, so you get your date here, August 15. Right, interest on note. All right, remember that these are how to compute the interest, principal, time by interest, time by time. Right, time represents the portion of a year that interest has accrued on the note. It may be expressed as a fraction of a year in months. For example, number of months over 12, or a fraction of a year in numbers, in days. Yeah. So for example, here you have a principal is 1,000, interest rate is 6. 12 over 12 means that it's for 1 year, right? In this case, you have 9 over 12. It means that the interest rate is 10% per annum. Yeah, so whenever you have the rate here, the 10% is always per annum. But, right, in this case, your note is only for 9 months. So you have time by 10% times by 9 over 12, because the rate mentioned is always per annum. All right, for example, you have 12% for 60 days. So 12% is per annum, but your note is only for 60 days. So 60 days over 360, 65. It's 9 months, so 9 over 12 months, right? So it depends on the how to. So the more important thing is that how for you to compute the amount of interest, the principal time by interest rate, time by the time. Right, accruing interest revenue means that you must, whenever the time need, you have to recognize your interest. Yeah, so you have 1,000 30th 2019 for 1 year at annual interest rate of 6%. So for year end 2019, all right, you have September, you have October, November, and December, 3 months. Yeah, because this one is already end of September. So you don't include September in your computation. So you only have for 2019, the interest is for October, November, and December. So there are 3 months over 12, and the rate is 6% per annum. So the interest you are going to receive at the end of 30th of December, which is not received but receivable, is $15. Right, and now you recognize the interest revenue, which is 15 at the end of 31st of December. Honored notes receivable. So if you earn 9 months of interest, then you have 15 and the balance of 45, which is for the following year, right? How is it? Recording honored notes receivable. Yeah, so what is this? Note receivable is 1,000, interest receivable is 15, interest revenue is 45. How do you get that 45? You have interest receivable 15, 45, so you credit your interest revenue. Oh, this one is September 30th, right? So just now interest receivable, you have debited 15 in the previous period, right? The interest receivable is 15, so now when you receive, you actually receive, you have recognized your revenue 15 here, right? So it's settled. But this interest receivable is a account, then you have to credit later. So that's why interest receivable you credit here. So when the period you are going to receive 1060, which is the 6th interest period, 6 rate, what is the 6% interest rate, right, for 12 months period. So you're going to receive 1060. But you have to close your notes receivable, right? Initially you debit your note receivable, now you credit your note receivable because now it's settled. Credit note receivable Holland 1,000. Interest receivable is the one that you debited in the previous period, and interest revenue 45 here is the amount that you're going to recognize for the second period, right? So coming back, the 15,000 interest revenue you have recognized. So, but during 2020, you're going to recognize another $45 of interest revenue. But the interest receivable here, all right, receivable, but you're going, when you actually receive, right, then you actually receive that amount. That's why you credit, you're going to close that account's interest receivable, right? I know that it's confusing, but that's how it works. Yeah. What is the time now? Okay, I have 8 more minutes. Honored notes receivable 2,000, sales revenue 2,000. So December you record a 10% receivable, right? So in this case, another example is that 2,000 and then 9-month promissory note at 10% annual interest rate. So remember that this one is July 1st. So when you have December, you have 6 months, right? July, August, September, October, November, and December. So that is 6 months. What is the rate? The rate is 10% per annum. So how are you going to record interest receivable? 2,000 times by 10% times by 6 over 12, because this until 31st of December, which is your year end. So you're going to put it as a receivable 100 and then interest revenue recognized as 100. But when it comes to your payment, all right, which is 9 months, in April 1st, then you're going to receive the principal 2,000 plus the total interest. How much the total interest? Total interest is for 9 months, 2,000, right, times by 0.1, darab dengan 9 over 12. So the interest portion is 150. Right, so you receive 2,000 plus 150 interest. So notes receivable, you're going to credit because you're going to close that note receivable. Interest receivable is the one that you recorded during December, and interest revenue is the one for the period from January to March 31st, 2020. So that is the balance of the 3 months, yeah, which is not recognized yet, is the interest revenue. Okay, anyone which is not clear about this, you tell me. Are you clear? Right, so the first one is number 1, July 1st, you record the notes receivable and then recognize the sales. December 31st, you recognize the interest receivable for the period of 6 months, July until December. And then you recognize your interest revenue. When it comes to the pay, on the April 1st, when you make going to receive everything, you receive cash, which is the principal plus the interest. So you receive 2,150, but you're going to close your notes receivable account. That's where you credit. You're going to close your interest receivable 100, but interest revenue is credited. That is your revenue for the 3 months period which has not been recorded. All right, so this is similarly, it's the same example, but in this case, they put it as a 60 day. So when you have 60 day, you have to over 365. Huh? right? So the interest is 12% per annum times by 42 over 365, which is the period from November 19 until 31st of December. How you compute November 19? How many days in November that is interest? So November you have 30 days minus 19 days, right? So you have 11 days plus 31 days, right? 31 days in December, so that's how you get 42 days. November you have 30 days, right? And then the interest it started from November 19, so 30 days minus 19, so you have 11 days plus 31 days in December, so total you have 42 days. So that is the interest receivable and the interest revenue for the period 42 days. All right, when it comes to January 2020, right, you receive everything. So you're going to recognize the balance, yeah? 42 days is recognized here, and then the balance 18 days interest revenue will be recognized in the following period. Yeah. All right, what you call dishonored, it means that the amount which is unpaid, right? The dishonored note and the unpaid interest are transferred to account receivable. This one is dishonored, it means that dishonoredly means that it becomes a bounce check. Yeah. Suppose Rubinstein Jewels has 6 months, 10%, 1,200 from Mark Adair. All right, and default, Rubinstein Jewel record the default as follows. So you're going to debit your account receivable 1260. How you compute 1260? 1,200 times by 10% times by March 3rd. So it's 6 over 12. Right, so you have that 60 interest revenue. Right, so account receivable 126, notes receivable 1,002, and then interest revenue 60. A dead default, so that's why. Oh my god, what happened? When you default, it means that right, a dead default, that's why it becomes dishonored. So what you do, you are going to debit again your account receivable, and then you're going to credit your note receivable and interest revenue. So you cancel your notes receivable, but you create account receivable. Yeah. Wow. Hey, we managed to finish 68 slides. Right, not bad, not bad. I almost lost my voice. All right, so I want you to do to revisit the slides, all right, especially in the method of computation of these, which account to be the journal entries. Okay, I'll give you the tutorial question and we'll discuss please do the tutorial question and we discuss that in the next class. Is that okay? All right,
Okay,
I will add on the classwork. I will edit. I will add on. Hold on, yeah. We are going to have your group exercise on receivable, yeah. But make sure I make sure that we only have the GE after we do the tutorial. So we are among the class that are left behind. I do not want to go very fast, but my students cannot follow the lecture. What is the tutorial? Tutorial on receivable. Okay, what they do a tutorial. 1 and 2. Okay. All right, safe. Okay, so please do all the question, all right, so that we can discuss on Thursday. And inshallah, I'll see you again on Thursday with all your answers and we'll discuss a bit on that. Is that okay?
Okay, madam.
All right, please don't forget to fill up your attendance form and your feedback on today's class. Right, so with that, I thank you again for your attention and I'll see you inshallah next time. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam. Thank you, madam.
Thank you, madam. Thank you, madam.
All right.